This is Chris Reddick with Chris Reddick Financial Planning. In this blog post, I talk about strategies for tech workers to manage taxes on their RSUs. So this is a common topical issue that I hear about is these restricted stock units, right? How do you manage your taxes? So say you work for a tech company. Okay, typically they're public companies, and then you get stock units, RSUs, typically quarterly, could be monthly or so forth. So essentially, you have this vesting schedule. So it could be over 4 years. Every quarter, you get so many stock units. So basically, you get so much stock every period of time. So basically, the stock vests, and after it vests, that means it's yours, right? So it gets placed in the brokerage account, and then taxes are withheld, federal, FICA, payroll tax, Social Security, Medicare, state income tax if that's applicable, and then you get the remaining shares. Okay, so that's essentially how they work, and really there's nothing complicated at all about the taxes. So people think it's much more complicated than it is. So basically, think of it like a bonus, right? So if you get extra money at work, like a bonus, like $20,000, $30,000, think of the same thing, but you're getting it in stocks. Okay, so the stock of your company, so a publicly traded company, and then so what the question is, what is the action you take after the stock vests? Do you keep it? Okay, so do you keep it long term? So if you keep it for 1 year and 1 day, and you have to be over a year, if there's gains on that, there could be long-term capital gains, which is a more favorable tax treatment than your ordinary income tax is typically. Not always, but typically the case. So say you're in the highest tax bracket, 37% tax bracket, federal tax, and then your long-term capital gains rate is 20%. That's pretty good savings in taxes, 15% savings in taxes. Okay, so you can see if you hold it long term, then you can take advantage of long-term capital gains rates. Okay, so and another issue is withholding of taxes. So after these RSUs vest, there's a withholding, and typically this is called supplemental withholding, and it's between 22% for under $1 million, and then the highest marginal tax bracket of 37% over $1 million. So most people RSUs would be under $1 million, so it would be withholding be at 22%. Okay, so that may sound, well, that seems about right, or it really depends on what your marginal tax bracket is. Plus, when these RSUs vest, basically what they do is it's more income, and it can push you up into a higher tax bracket. So it may not be 22%, it might even be 37%. So what happens is, and a lot of people get surprises, is that when they file their taxes, go, wow, what happened here? All of a sudden I owe all these taxes I didn't expect, and you say, well, I did all this withholding. Part of it is explained by these RSUs, and if it's only 22% withholding, and then you get a lot of RSUs at once, which is a lot of income, pushes up the higher marginal tax bracket, and not enough withholding. So what you do is you adjust your W-4. So what is a W-4? It's used typically when you start a new job, you fill out a W-4. So you have a W-2 with your pay, and W-4 basically tells you how much withholding you should have. So you would put married if you're married, right? So there typically be a little less withholding than if you're single, because the way the tax works for married versus someone filing single. Okay, so there would be impacts on that. So a lot of people don't even know what a W-4 is, and they may not have it revisited. So you have to go and revisit that and maybe adjust your withholding. You could do extra withholding each month, a fixed dollar amount, or you could make sure you pay your estimated taxes as well. So that's another thing you might want to think about as well, which is what a lot of people don't think about is estimated taxes. Like you file your taxes, and then you see these little slips, right? And basically you need to pay quarterly estimated taxes if you didn't withhold enough last year. Okay, so there's a lot of technical things here, but essentially making sure you pay your estimated taxes if you need to as well. So adjusting your withholding on the W-4, making sure you pay estimated taxes. Think about long-term capital gains, holding it 1 year over 1 year, the stock. And another thing to think about is when RSUs are vested, essentially you already paid the tax, right? So what's remaining, okay? So after it's vest, you have the shares, and then any gains or losses that would have tax impacts. So at that point, there's a decision point: is should you just sell them all and then diversify, and then hold it in maybe a low cost ETF portfolio or something like that. So that can be a good strategy as well, right? Not having all your investments into one company. Diversification obviously makes sense as well. But for all these issues, make sure you talk to a financial advisor and look at your individual circumstances. So I hope this was useful for you. Reach out and if you want to talk further about your RSUs. Have a great day.